This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Mark Casady of Vestigo Ventures. Mark, thank you for joining us.
Glad to be here.
Can you tell us how you got into early stage investing?
Yeah, happy to. I had a career in financial services for almost 40 years. I can't quite believe that. And that background has always led me to technological solutions for financial problems, whether it's financial planning or whether it's solving for operational processes or lowering costs in a financial institution. And I retired from being chairman and CEO of a public company, LPL Financial, about 18 months ago. And so wanted to take that focus on technology into the early stage FinTech area because there's just so many good things happening in that space. And I think so many opportunities to really change the industry in a very positive way and also to make a fabulous return for myself and for investors.
So tell me more about your fund and how that works and what kind of startups do you look for that you focus on?
Yeah, the fund is, we're just closing up. We'll be closed at the end of June. We're at 45 million collected today. So that's exciting. And we had targeted 50 million. And I think we'll probably get there in the end. And we obviously put our own capital in as well. We're general partners. The two of us are 10% of the capital for the fund. So we're big believers, in the space. And what we wanted to do was focus on early stage because early stage companies can benefit from just day-to-day help. Everything from who should I hire next to how do I tackle this technical issue, and basically assembled between the four of us as partners at Vestigo a lot of operational expertise, technology expertise, and venture expertise to create Vestigo. And we like the early stage because we can bring that expertise to help the companies. We also think that in financial services, it's going to go through as much change as other industries have gone through because of digitization. We certainly have all seen it and experienced it, from newspapers to music to whatever. And it's time for financial services to have its turn, hit that round. But then it will happen very differently than it happened in other industries. Because of regulation and because of brand advantages and data advantages and earnings advantages that incumbents have, that basically it would be smarter for startups to really work with incumbents in financial services so that they both benefit. The startup brings some new idea. Maybe it's an application of AI for marketing or brings some new way of looking at data. And we have an interesting company that looks at tax efficiency in portfolios, for example, and that they would be best served to really create a B2B model, helping banks, credit unions, insurance companies bring those capabilities into their world. And so far, with about 2 years of doing this and 6 companies in the portfolio, I think we're seeing that thesis really start to play out a bit.
So unlike other industries where startups disrupt the incumbents, sounds like you're saying in FinTech, there'll be startups cooperating with the incumbents, and maybe the incumbents are the customers, not the end users of the technology at the end of the day. How is it alike and different in more detail, if you can tell us about how FinTech will disrupt versus other areas that we've seen out there like real estate or ed tech or what have you?
Yeah, no, it's great. It's the right premise, Hall. That's our premise, right? That may not be everybody's premise when they invest as a venture capitalist in this space. But our belief is the incumbents do have inherently a bit of a moat because of regulatory structure, and that, say, unlike the UK, where the regulators have created a little easier on-ramp to go direct to the consumer for a startup bank or a startup FinTech company, that's not been true in the US market nor in Canada yet. And that there is, if you're going to think about, what is it that is needed among incumbents, if the incumbents were intractable, if they said, look, we don't believe in the power of data management or big data, we don't believe in AI, we don't believe in blockchain, right? If they were saying that, then I think they probably would be ripe for disruption, and someone would likely figure out a much lower cost method to directly deal with the consumer. But that's not what they're saying. They're saying, we get that these are important trends. And I've been shocked in just the last 2 years how rapidly large incumbents in financial services have embraced startups and are doing some very innovative programs to allow them to connect to their data, to connect to their customers, and bring that new way of dealing with things right to the front door. So I think you've got a willing incumbent, you've got a bit of a regulatory moat and a capital moat, and you've got a startup who brings really fabulous talent and some new ways of doing things. And they can get traction much faster, as you premise, by working directly with the incumbent, the bank or whatever, than they can by getting traction trying to go direct to the consumer. And that's the last thing I'd add to it is that customer acquisition cost is difficult in any industry. It's the number one reason, in my view, that startups succeed or fail is can they get their CAC down. There's been a lot of good work. You've probably had other people on your show that have talked about this very thing. And in financial services, customer acquisition is unusually expensive and unusually difficult. And therefore, if you look at things like robo-advice, which has kind of caught the popular imagination, they are really, really expensive to acquire that dollar of assets to manage for a customer. Like, hard to see what the payoff would be of having acquired it. And therefore, the business model is unlikely to monetize fast enough for that startup to really gain traction and become a more permanent company. So I think it's the uniqueness of customer acquisition is the final point that I would just make that's there.
Well, there's a number of new technologies coming up, blockchain, AI, data analytics, and others that are all promising to save us from the future and so forth. And the question is, which of those technologies, and not just those three, but any, which do you think you'll see the biggest impact coming from those new technologies on the fintech space?
Yeah, to me, it's artificial intelligence. It's AI. It's basically taking algorithms, right, and applying those to data sets. The data sets could be small, they could be big, depends on what you're looking for, and essentially automate processes that are sometimes human processes or done in less efficient ways. So to me, AI is the big one that in that wave or that list that you rattled off there that is the most promising. It seems to be the most commercial at the moment. Blockchain is getting lots of hype, to say the least. We've looked at tens of perhaps 50 different blockchain ideas out of the 450 business plans that have come our way. And we just have not found one to invest in. They tend to either work really well for consortiums, so they're not so great for VCs. And so therefore, a group of insurance companies get together, they create an application using blockchain, and they all own the entity and finance it, and they all collectively benefit from the lower cost processing. Those models are good, but they're hard for a VC to invest in and hard for an angel to invest in. And those are the ones that have been most promising that we've looked at, but we've declined them for that reason of return. And then the next most promising for blockchain is really around the way the new crypto world will get created. We can talk about that in a minute. But let me just talk about data, because one of the things that is unusual about Vestigo is that the other general partner with me is a gentleman by the name of David Blunden. Dave is on the X Prize Foundation, awarding the X Prize. He's a software multi-time startup and successful seller of startups over his career. And he created something called Kogo Labs about 11 years ago. And Kogo Labs is essentially a large database of consumer activity on the web. It's about 5 petabytes in size. That would be, for those of us in my age bracket, that's 200 Libraries of Congress. And for those perhaps in a different age bracket, that's all the data eBay would have, for example, or Spotify around its customers. So it's an enormously large database getting fed with new information every day. And from it, we can see what consumers are looking for. So we're big believers in big data, right? That's a big data set. We're big believers in AI because that's what we can apply against that data set to get those insights. It's what lets us understand what consumers are trying to solve for in financial services. So Vestigo has the exclusive rights to use that Kogo Labs data to understand whether the startups that we're backing are getting traction in a B2B structure, or we can see the competitive set that are there as well. So we're big believers that big data has a very bright future, particularly when combined with the algorithms that are commonly called AI to create new processes.
Where do you think AI is going to have its initial impact in the fintech services space? There's a lot of different segments out there with back office software for banks and retail bank communication with customers, with mobile apps, with payments, with disbursements, there's just a lot of different elements that fintech covers. But where do you think the early wins will come for AI?
Yeah, a little bit of all of the above, right? So what we've seen so far, again, out of that roughly 450 business plans that have come to us since we've opened the organization, Vestigo, is that we're seeing what I would describe as single point applications. So it's an application using the bank's data to then use AI to essentially look for and posit what a customer may want, and then getting a survey question to that customer as they're in checking for their balances or whatever, so that they can basically understand better what the consumer may want, and then basically help the bank get a banker to reach out to that person or create solicitation for them. So obviously, that might be that the data showing them The consumer's looking to buy a new car. They can ask the question that person, that client, and see if that's the case. And if it is, they can then get that lead to the bank to follow up on. Have about a 30% improvement in sales. That's a single point solution. I take this information, I go and solve this problem, I deliver a warm lead to a banker. And I think those are the applications. It can happen in reg tech. It can happen in any kind of operational processes, but I wouldn't try to create the all-knowing, all-seeing AI for operations for a bank, right? Or I wouldn't try to create the all-seeing, all-knowing marketing application for an insurance company, because that's going to be too much in terms of the way you're trying to solve it. Invest too much time without getting good customer feedback or without being able to prove that the AI actually is adding value.
So what are the other hot button issues that are coming up in the fintech space now with respect to startups and new emerging technologies? What is we not covered so far?
Well, I think the one that is certainly capturing the public imagination, and I'm sure will be interesting to you and to others, is the whole digital asset area. So it's commonly thought of course, as Bitcoin or cryptocurrencies, or Ethereum and the like. And then there's also the ICOs, which are initial coin offerings that particularly software organizations are putting out there to create a distributed ownership structure for their software and to create a really different corporate form. And so without going too much into it, because we could spend an hour on this topic alone, what I think is happening is we're seeing kind of the land rush, right? The excitement and the boom of those currencies. We're seeing a bit of the bust as they've come down the other side. That's all very healthy to me. And we're seeing really interesting investors, interesting entrepreneurs come into the space trying to understand what this is all about. And I think quite simply, the way to boil it down is people want a way of storing value that's easier than storing it in gold, right? Or storing it in other types of commodities that they've had. We're in the digital age, particularly the millennial generation and younger. You would like the convenience of being able to do all that on their phone. And so crypto assets have a unique way of being easy to store value. They do seem to be a bit counter-cyclical to more conventional markets, but today it's really just a digital asset with no real connection to something in the real world. Bitcoin isn't used to commonly do transactions to buy a book off Amazon, for example. So there's very limited ways to understand what is the real value of these currencies. So what we're investing in, we have a company in the portfolio now that's trying to become the information source and pricing source of crypto assets. So all the infrastructure that you need for that asset category is the place we're looking to invest. I think will ultimately create real value in that category. And I think that category will legitimize and become more mainstream over the next several years. And therefore, it should represent an opportunity to invest in, even though it is still very unproven and very early days.
What's your take on things like Crypto Kitties, which is a piece of artwork where you're actually using the blockchain to create the artwork and do the various permutations on it? And then now that's installed on the blockchain in a way that can be monetized. And so moving assets onto the blockchain now gives it a place where you can track and transfer and hold different assets itself. What do you think the future of that is? It looks really interesting, but I'm not quite sure how to place it into the regular fintech context. What's your take?
Yeah, my take is that it's the market trying to find a way to connect a physical good or something that we can understand as humans has value and to translate that into a crypto asset. That's all to me, that's all it's trying to do. The analogy I use is gold. If you put all the real gold in the world together, it actually isn't physically that large. It's relatively a small amount of actual gold that's available. Yet you and I know that gold has a certain value, right? And there's whole financial markets, futures, options, and so forth that are created on top of that physical good of gold. And that's because the financial aspect of gold essentially can be translated down into the physical aspect of gold. So there's a translation vehicle that's there. So CryptoKitties and a whole range of other things that I've seen are all trying to find ways to equate to a physical item's good or some other good that we can translate to. The most recent one that I've talked to people about is real estate. Let's say that I owned a 6-flat here in the Boston area, which would be a good investment for me, right? As things go, and I get lovely rents off of it. It's a hot rental market here. So I like the physical aspect of it, but I don't want to own all 6 of those flats. So I could go out in the world today and I could get a cousin or get a friend to buy one of the flats from me, and I could kind of create my own security of that building, right? Well, wouldn't it be easier if what we could do is just sell a token that represents an interest in that 6 flat? And let's say I might say, well, gee, I'm happy to have 100 owners with me. I don't care. And maybe I'm willing to sell up to 49% of my rights to the rents of that building over time. And so wouldn't a crypto asset be a really nice way to do that? You could create very small bite-sized pieces for someone to build a portfolio of a 6 flat in Boston, a 6 flat in Washington, D.C., and maybe one in Chicago, so you can diversify. And you have this translation of a crypto or digital asset equated to a real physical asset. So these are all expressions of the market trying to find how to digitize and securitize real assets using this new digital format.
Well, it seems like that opens up a whole new world. If you aren't on the internet or you're not digitized, then you're not recognized by the digital world and you don't exist. Just like the farmer in Africa that does not have a bank account, the financial world does not recognize that person doesn't
Right.
exist. And so by taking crypto assets and turning them not just gold or real estate, but actually other intangibles like art and music and others, it seems like they're finding a representation in the digital world that lets you control, monetize, transfer, trade, etc.
Yes.
And it seems like that opens up a whole new world of payments to people who are not getting paid now. I know many music artists thought they'd live off the royalties of their songs, but then when it went online, people just traded it without paying the artist.
Right.
But now we're putting in mechanisms to capture that value and capture that payment. What do you think the implication of that is?
No, I think you're right. I think there's lots of ways to think about digitizing any asset. I think there's lots of ways to think about how you organize the labor around the digitization. So let's go back to your example of farmers in Africa. I just saw a business plan that we're engaged with, we're really intrigued by, that essentially is working with farmers. Most are carrying a smartphone of one type or another. They've kind of, as you know, leapfrog technology. So this is obviously a group of people who are landowners, so they're not necessarily unbanked or unconnected to the internet. In fact, they are connected, but they are providing information back via the blockchain. So therefore, it's transparent and easy to identify their assessment of crops. In this case, it's East Africa. And then the startup is basically collecting that information and then using that to predict commodities prices and essentially providing transparency and a lot better data in a market that doesn't have it today. So the farmer then potentially could hedge their risk if they see that crop yields are high, right, which means prices are likely to come down. They could hedge at prices today and lock in an economic price that works for them. So there's just all sorts of ways to think about how you apply the digitization of real assets, or, as you say, turn it into a payment mechanism. My other analogy I sometimes use is, why wouldn't Amazon issue its own digital currency? It could avoid the banking system for the most part. It could help its merchants that are on Amazon today essentially get a payment system that doesn't take 2 or 3% of their returns out of it. So there's just lots of ways to apply it. Our view is that we're not smart enough to know exactly how that's going to play out, right? So what we need to do is make some smart bets around the infrastructure in that world, but not necessarily make bets on specific ICOs or specific digital currencies, because that's really speculating about an asset, not speculating about a technology that would change financial services.
Well, great. Well, it's certainly changing very rapidly, like you mentioned before. In the last minute or two, what else should we cover that we haven't?
Yeah, good question. So we see a lot of insurtech, and they're excited by what we see there. I think there is some overlap to consumers in terms of better information, faster claim processes. Generally speaking, we believe that the intact infrastructures, advisors in insurance or advisors in investment advice, are likely to stay intact because they have a relationship with clients, and because as wealth gets created, people tend to like to talk to people about it. So we see, when we think about our portfolio, what we're trying to invest are in tools that help those advisors be better. So in insurtech, it would be a tool that might make it easier to underwrite certain P&C insurance or life insurance. In investment management, it might be a tool that helps illustrate the power of investment advice for an advisor. So even though the world's changing a lot, right, some things will still be true in terms of how systems operate, particularly in the U.S. market, which is our focus. And so I think part of our way of thinking about it is, how do we invest in those tools and technologies and startups that assist the intact distributors and manufacturers in the financial services world. I do think that theme so far for us has worked well, and we see a lot of opportunities to invest in things that we looked at 2 years ago that were direct to the consumer. We just have had a rash of them recently that we didn't invest in because they were direct to the consumer that actually have stopped operating. So they really have had a hard time finding traction. So it's there. But I do think it's an exciting moment in fintech. Vestigo is the only early stage professional VC in the Boston area, for example. We've got these wonderful universities, wonderful students coming out of them interested in the topic. We've got a large financial institution incumbent group here in the Boston area, and 5 of our 6 investments are from the Boston area. So we're excited by what we're seeing in the startup ecosystem and what we're seeing in the application of some of the technologies that you mentioned earlier, like blockchain and AI, to really make the world a bit better place in terms of what you do. There's 2 themes that I just point to, Hall, that may be helpful. Is in financial services, I think the 2 themes that are going to make a difference is, can I drive down cost and can I delight the client? And at the end of the day, if the startup does one of those or both of those, they're going to be very successful. And if you're an incumbent, you want to keep thinking about, how can I drive down my cost? How can I drive up my customer delight? And because those are the things that the disruption, we've learned from digital disruption from other industries, right? That music's probably the most harsh, because effectively you say it went for free. That's not good because the artist isn't being paid. But assuming that there's an economic charge for something, how do we drive that cost down? How do we make sure the client's delighted by the results? If we do that as an incumbent, you do that as a startup, you're going to be very successful.
Well, that's great. So in closing it out, what's the best way for the audience to get in touch with you?
Yeah, they're welcome to send me an email at mcassady, and Casady is spelled a little funny. It's Casady at vestigoventures.com.
Well, great. Well, we'll put that in the show notes and let that be available to everybody else. Appreciate your taking time to talk today, and hope to have you back in the future for a follow-up.
That sounds great. I'll really appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.